Having understood what are assets and liabilities, let us now try and understand where these assets and liabilities come from. So let us go back to the time when the company was raised or the company was started. Let us say you started the company with a capital of $100 million. And at the time of starting, you may have pooled money from various sources. Say 20 million as a promoter you would have given from your pocket. Another 60 million probably you may have garnered from the public by issuing them shares and making them stakeholder in your company. So together this 20 million and 60 million, that 80 million is called as the share capital or the shareholders equity. You were still short of 20 million and you would have decided to borrow this 20 million, some portion from the banks, some portion from the financial institutions, and some portion from the public by offering them bonds and debentures. Now all this money which you borrow would carry some amount of interest and it has to be returned in a stipulated amount of time. So this 20 million is now called as the debt. So you have collected 80 million as equity and 20 million as debt. What would the company have done with this 100 million? It would have purchased land, constructed the building, bought the plant and machinery, tools, equipment, and all those things which were required for functioning of the company. And thereafter, some amount would have remained as cash in bank. So now this 100 million which has been garnered in the form of equity and debt, that goes into the column of liability. The shareholders capital also goes into the liability column, and the debt which you have taken, that also goes as liability. What is the difference between the share capital and the debt? Why do both of them go as liability? The reason is that the debt has to be returned in a stipulated amount of time along with some interest. So it is very clear that it is a liability. Alright, but why the share capital? Share capital is also a liability because though you are not promising a guaranteed or fixed return to the shareholders, and though there is no specified time for returning that money, in fact that money is not to be returned as long as the company is live and functioning. But someday when the company winds up or when the company shuts down, at that time everything will be sold off and auctioned, all the dues will be cleared, and the balance which remains either in the appreciated form or depreciated form, that has to be returned back to the shareholders. And therefore till that point of time the shareholders capital remains as a liability. And what happens to this land, building, plant, machinery what the company has purchased? These are the assets of the company, so they go into the asset column, and they are clubbed under three broad heads. One is the fixed assets like the land, the building and other things which are not liquidated for the normal functioning. And then there are current assets, which are the assets which can be converted into money within a period of say 1 year. We will see about the fixed assets and current assets subsequently in the course. And then there could be certain things which can be clubbed in the head of other assets. Alright. Now if you want to have a look as to how the balance sheet is defined in the books, then it will be something like this. A balance sheet is a document that reveals a company's assets, liabilities, and shareholders' equity on a particular date or a specific point in time. It is basically a snapshot of what a company owns, what it owes to others, and the amount invested by shareholders. Have a look at each of the word which is highlighted. Every word has got a meaning and some significance. The first one, the balance sheet is a document or a financial statement as on a particular date or a specific point in time. It does not cover a period, it is for a specific instant. And at every given instant in the 365 days of the year, the assets and liabilities have to be equal. Alright? Normally, this date is the last date of a quarter and the last date of the financial year. Alright? Then it reveals what the company owns. All this thing, 70 million, 20 million, and 10 million, which are the assets of the company, this is what the company owns. Alright? And then what it owes to others. This 15 million and 5 million is something which the company owes to others, to the banks and the financial institutions and the public from which it has borrowed. And thereafter, the amount invested by the shareholders. All right. So these are things which are covered in a balance sheet.